Hello friends, I'm welcome to my YouTube channel Simply Stocks, and today I'm going to talk about Elgi Equipments, a company in the agricultural space, whether you should buy it or just avoid it. So let's get started. First of all, a disclaimer that this is not a stock recommendation. People taking any position to any share that I talk about should do that with their own due diligence and research, and I'm not in favor or against any company that I talk about. Before I talk about Elgi equipment, a small request that kindly support me on Patreon, and once you do that, it will help me grow the channel, help you also ask me questions in greater detail. Once you get the $10 membership, you will have access to my portfolio, my watch list, and a number of podcasts that I put up from time to time. If you get a $100 payment straight away, if you pay me for $100, then you get a 12-month subscription for paying for 10 months, so you get 2 months extra. For detailed market or company talk or number of stocks you are holding and you want it analyzed, kindly email me and we can work things out. And if you cannot pay via card, contact me on email, and probably in a few months time I'll start direct bank transfer. Now about the company, Elgi Equipments was established in 1960 and they provide compressors for irrigation motors and farm equipment. So you understand that they are into providing ancillary products for farm equipments. I'm sorry. And probably this is one of its kind business, a niche brand, a niche company, and it is the top brand in its segment. So if agricultural growth takes place big time, this company is going to go a long way, and that is why marquee people are into it from a longer term perspective. But if you take a shorter term perspective, then of course this year's monsoon it is expected to be good. So let's see how the company would end up doing. Have operations in more than 18 countries, so they export to other countries as well. And once things really pick up in the rural area, it will take a little bit of time. Once it picks up, the numbers will look much better and the stock will surge. They also produce railways and medical compressors, and the market cap of the company is around 7,000 crores. So a small cap company, but not very small, not a micro cap in that sense. If you look at the financials of the company, then sales went up by 18% in the December quarter, but look at the jump in profits of around 280% to 34 crores. Cost efficiencies helped numbers, other income helped numbers, and really cutting down on cost, as many other companies have done, has really helped the numbers boost up on the bottom line. But even a sales growth of 18% is pretty decent in the environment that we are living in, and the company is doing pretty decently with an ROE of around 14%, but the operating profit margin need to improve. It is around 9%. If it becomes into you can say teens, lower teens, it would be much better. If you look at the performance of the stock, so stock is at 5-year high at the moment. So stock has surged over the last year or so, year and a half. Numbers have declined over years. So what has happened is operationally numbers have declined, but they are starting to come back. So you look at the last quarter numbers, pretty good. But if you look at 2-3 years back in 2017 or FY18, the numbers were very robust compared to what they are today. So in that sense, numbers have declined, but the stock price has surged. So there is a dichotomy for that, a disconnect with respect to that. But rural economy is coming back. I feel in the next 2 quarters there could be some trouble because of the pandemic, etc. We have to see how it goes, and we have to be careful. But over a 3-4 year time frame, rural economy should pick up even more. Promoter holding is extremely low, and that is a big negative in that sense, and investors will not like it. I think it is still trading at stretch valuations, and in that respect I believe that it let the stock correct at 15-20% and only then get into it. That would be my opinion. So why I believe it is an avoid. Very low promoter holding. Promoter holding is extremely low than 50%. I normally look at stocks which have 38, 40, even 40 to 50% promoter holding, or if there are large promoters attached to it, large people attached to it apart from promoters, fund houses, etc. But there is dearth of that as well, and numbers have to show consistent growth. So currently it has shown on the bottom and top line. I have to see at least 3-4 quarters of consistent growth, and only then probably ready to buy into it. And that is why there is trouble for the stock, that if numbers keep coming errantly, then the stock price may just end up going down even further from here, and recovery may take some quarters. So what will happen is at least 2 3 quarters of good numbers will only convince me. And you have to understand that the stock has surged over the last year and a half a lot, and at 5 year high right now. And that is the concern, that although numbers have not picked up that much, the valuations have become stretched with the stock going up so much. So there are other rural play availables in tractor, in agrochemical, rather than buying into this company. That is also a reason why I would avoid, and that is probably one of the biggest reasons why most of the large investors do not get into Elgi equipment. They have other stocks, other pedigree stocks with brands, etc., in agrochemical, in tractors, in machinery, etc., which they like to get into, seed products, and so on and so forth. If you look at the technicals, then there is strong support between the 175 180 region. So around 170 180, you could take a chance and buy it. So when I talk about technicals, I'm talking of short term here. Long term, 150 160 can be a good support, but I would wait for at least a 20% decline from current levels to even think about buying it. It is slightly stretched. It is stretched on valuations as well as technically. I believe that there is a decent amount of correction on the anvil, and only then probably look at it. If you are having the stock, then probably what you do is hold on to the stock and add more at 160, and probably in the next 2 3 years you will make money. But if you're not having the stock, I would say that it's better to look at other agrochemical tractor plays, or in other sectors, consumers, pharmaceuticals, IT, etc. Even you can say consumer, other types of consumer centric businesses, rather than looking at the stock. So yes, those who are invested can wait for massive declines of 20 25% to accumulate, and probably one the fine year when it surges, you take the money off in profits. Otherwise, I see that it has cleared all resistances on a 5 year chart, but the valuations are stretched. So I believe that there could be some amount of consolidation and decline. So what needs to be done? In my opinion, it is an avoid for the time being. I think valuations, if the valuations become cheap, if the stock goes to 150 from here, 215, 210, if the stock really goes to 150, 160, then I'll definitely look at it. At these levels, I will not. Look at top consumer brands, look at top, you can say IT brands, etc. If you feel like this pandemic can take about a year and a half, then IT and pharma is going to do well. I have a portfolio of pharma stocks that I have made. I mean, I made a video on. You can look at that. Only buy when economy picks up steam. So this will really do well in higher economy on and better economic growth scenario. Right now we are in desperate trouble in that sense. So that's why I probably stay away from it. Simpler businesses coming at attractive levels would be a better option. At 14,300 we are more simpler businesses, even in finance, in lending, are coming at very good valuations. So this was my video on algae equipment. Please like and subscribe my channel, hit the bell icon so you can get my videos straight away when I post it. Thanks a lot for watching.